I'm Sarah Richards. I'm an audit partner with Gallagher Flynn, and today I'm going to talk to you about ASC Topic 606, Revenue from Contracts with Customers. This is a new accounting standard that is generally going to be effective for calendar year-end companies on January 1st, 2019. This new standard is notable for a couple of reasons. One is that it replaces all existing revenue guidance. The other thing that is really notable about this new standard is that it really represents a shift from a rules-based guidance that is specific to each industry. This new guidance replaces that with a principle that can be applied broadly to all industries. So this new core principle, you'll notice, is focused on the transfer of control as opposed to being focused on the transfer of the risks and rewards of ownership. You'll also note that the concept of the total consideration that an entity expects to be entitled to has been incorporated into this principle. Previously, the accounting standards have only allowed for inclusion of consideration that was fixed and determinable. This new concept of variable consideration may have a significant impact on how companies recognize revenue. So the impact of this new standard is really going to vary by industry, but typically companies that enter into contracts with customers that contain multiple goods or services bundled together in one contract are going to be the most significantly impacted. Industries such as software and technology, construction, and engineering are likely to see the most significant impact. Additionally, the nature and extent of disclosures required in financial statements will have an impact on substantially all entities. So step one is to identify the contract with the customer, and this is going to include both any written contracts as well as standard business practices. Step two is to identify the performance obligations under the contract. This is a similar concept to that of deliverables under the existing revenue guidance. However, there are some additional considerations with respect to performance obligations. Step three is to determine the transaction price. So transaction price will now include the concept of variable consideration, and this will include things like contingent payments that previously were not allowed to be considered as part of your contract until the contingencies were satisfied. Step four is to allocate the transaction price. Transaction price is allocated to each performance obligation under the contract relative to their respective standalone values. These standalone values are required to be estimated at inception of the contract. Step five is to recognize revenue. Revenue is transferred as performance obligations are satisfied, which may happen at a point in time or over time, depending on when control of the goods and services are transferred. So another interesting thing about this new standard is that it doesn't just impact how companies recognize revenue. There are actually some provisions that impact how companies treat the costs related to entering into contracts with customers. In certain cases, these costs are now going to be required to be capitalized, which is a shift from the previous treatment. I mentioned earlier that there will be additional disclosure requirements that will impact all companies. These disclosure requirements are going to be more qualitative in nature and will typically relate to areas of revenue recognition which now require significant judgments on the part of management. Companies can elect from two options as far as how they implement this new standard. There is a full retrospective method available, or there is a modified retrospective method available. Which method companies elect will have a significant impact on how they determine their execution and implementation plan. It is important for companies to decide now which implementation method will be adopted, as this will drive the extent of information gathering and analysis that's required in order to implement the standard.